checkmate for a central bank is when they have high inflation, but for one reason or another, they cannot raise interest rates. So, for example, in the 1940s United States, at one point in the 40s, you had 19% year-over-year inflation, and they still didn't raise rates. And I think that right now, there's a number of central banks that are essentially checkmated, where there's, too much debt in some of their areas. Like, for example, Italy has 150% debt to GDP. Japan has 250% public debt to GDP. And so, they can't support 5, 6, 7, 8, 10% interest rates. The Fed has a little bit more leeway. And so they're still in the phase where they're at least trying to, raise rates from a very low level to try to combat it. But again, the Fed is kind of an outlier compared to a number of other developed countries, and you see a dollar strengthen too much, then you ironically have foreign entities sell treasuries and start causing problems in U.S. capital markets and the U.S. economy. And I think that ultimately forces the Fed to probably stop tightening by next year, even if inflation is still kind of running hot